Welcome to the Explainer. Today we're putting on our expert investment analyst hats and running Micron technology through an absolute gauntlet. We're not just glancing at a few charts here. We are taking this massive semiconductor player and rigorously testing its valuation using the exact frameworks of legendary investors. We're talking Warren Buffett, Peter Lynch, and Benjamin Graham, right alongside hard, modern quantitative models. If you want to know exactly how the greats would value one of the absolute hottest stocks in the AI supercycle right now, you are in the right place. Let's get into it.
Here is our roadmap for today. We'll kick things off with a quick snapshot of where Micron stands, pass it through the desks of Buffett, Lynch, and Graham, crunch the quant models, and finally reveal our master scorecard. Section 1. Micron Snapshot and Context, the AI Memory Bottleneck.
To understand Micron's current valuation, we really have to understand its explosive role right at the center of the AI memory bottleneck. As of our core Morningstar data snapshot, the stock is sitting at $127.25 a share, giving the company a massive $142 billion market cap. They're one of the big three pure-play memory chip makers on the entire planet. And this right here perfectly illustrates why the market is buzzing so loudly. In their latest reported quarter, they delivered a staggering 196% year-over-year revenue growth, hitting nearly $24 billion. Gross margins are currently at 74.9% and actually guiding upward toward 81%. Plus, they generated $6.9 billion in free cash flow and are sitting on a pristine balance sheet with $6.5 billion in net cash. All of this is being fueled by their high-bandwidth memory chips, you'll hear them called HBM, which are absolutely essential partners to NVIDIA's AI GPUs. Yet, despite all this explosive growth, the forward PE ratio is sitting at just 9.6.
Section 2. The Warren Buffett Lens, Moats, Management, and Margin of Safety.
Now, right off the bat, Buffett looks for an economic moat. He wants a durable, competitive advantage. While Morningstar assigns Micron a firm no-moat rating. Why is that? Because despite being the fifth largest chipmaker in the world, the memory chip market is intensely competitive and historically very cyclical. It's effectively a commodity market where supply and demand completely dictate prices. It just lacks those consistent, highly predictable economic profits that Buffett typically demands. So when we run Micron through Buffett's criteria, it's honestly a mixed bag. They easily pass the debt level test with that $6.5 billion in net cash. And their owner earnings, which we can approximate using their surging $6.9 billion in free cash flow, are accelerating beautifully. However, they totally fail on the economic moat and earnings consistency. The memory sector is just infamous for its boom and bust cycles. Because of that inherent lack of predictability, Buffett would demand a massive margin of safety. He probably wouldn't even touch this unless the price drops significantly below $80 a share just to protect himself against the next cyclical downturn.
Section 3. The Peter Lynch Lens, Growth, Categories, and the PEG Ratio.
Let's switch gears. To evaluate a fast grower, Peter Lynch relies heavily on the PEG ratio. That's the price-to-earnings ratio divided by the growth rate. He uses this to find growth at a reasonable price. In his framework, a PEG ratio of 1.0 is considered perfectly fair value. Anything below 1.0, that means you're getting all that growth at a discount. When we grade Micron on the Lynch test, they have an absolutely absurd forward PEG ratio of 0.07. I mean, that is practically zero. This is driven by Wall Street projecting a mind-bending 906% year-over-year earnings per share growth in its next fiscal quarter. You combine that with a bulletproof balance sheet, and for Lynch, this completely screams strong buy. However, we have to remember Lynch would categorize this as a cyclical fast grower. That means you have to watch inventory and pricing cycles like a hawk. He'd also be pretty wary of the competitor tech gap, specifically noting that rival SK Hynix currently holds a real edge in next-generation 1C DRAM yields. Section 4. The Benjamin Graham Lens, the defensive investor and intrinsic value. Next, we strip away all the growth hype and apply the strict quantitative framework of the father of value investing himself, Benjamin Graham. Walking through his checklist for the defensive investor, Micron actually passes almost perfectly. Adequate size? Yep, $142 billion market cap easily passes. Strong financial condition? Absolutely, they have far more cash than debt. Moderate PE? Yes, a forward PE of 9.6 is well within Graham's strict limits. But there's a catch. It fails on earnings stability. The historic volatility of chip prices would just make a pure, old-school defensive investor sweat too much. But let's apply Graham's famous intrinsic value formula. It's the square root of 22.5 times EPS times book value per share. If we plug in an assumed projected FY26 EPS of $60 and an estimated book value of $45, the math comes out to the square root of 60,750. That means the intrinsic value lands at a truly staggering $246.47. So at the current price of around $127, Graham's formula suggests a massive margin of safety. Based purely on the hard math, it's a buy. Section 5. DCF and Comparable Models, Crunching the Modern Quants. Let's step away from the legends for a second and look at modern, hard, quantitative models. To build a base case discounted cash flow model, we have to forecast free cash flows and discount them back to today. If we assume a standard 10% weighted average cost of capital, which appropriately accounts for the sector's high risk, and a perpetual terminal growth rate of 3%, we arrive at a fair value of $115 per share. Our sensitivity table shows how tweaking those assumptions shifts the value, but looking at our $115 base case, it indicates the stock is currently trading at a slight premium to its intrinsic cash flow value. And, this completely aligns with Morningstar's proprietary valuation model. They actually flagged the stock as being slightly overvalued at the last close of $127.25, directly compared to their calculated $115 fair value estimate. But things get a whole lot more complex when we run a comparable company analysis against Micron's fiercest rival, SK Hynix. While Micron looks cheap at a 9.6 times forward PE, SK Hynix actually trades at an even cheaper 6.1 times forward PE. Both have near zero PEG ratios, but SK Hynix is historically outpacing Micron in total returns. And crucially, industry sources indicate SK Hynix holds a distinct technological lead, specifically hitting an 80% yield on next-generation 1C DRAM, which is securing massive NVIDIA orders. In fact, Morningstar data shows SK Hynix is currently trading in undervalued territory. This strongly suggests that while Micron is undeniably a great company, SK Hynix might actually be the better pure value play in the memory space right now. Section 6. Synthesis and Final Verdict. Time for the master scorecard. Pulling all these threads together, we get a fascinating split decision. The growth at a reasonable price philosophy of Peter Lynch and the strict intrinsic math of Benjamin Graham both signal a resounding buy at current levels, completely driven by that hypergrowth and massive forward earnings projections. Conversely, the moat-focused Warren Buffett lens, modern DCF models, and comparables analysis all urge caution. They signal a hold at current levels, suggesting you wait for a dip below $100 or even $80 to establish a true margin of safety against cyclicality. The ultimate takeaway here is really one of balance. On one hand, Micron is an exceptionally well-funded hypergrowth engine perfectly positioned at the absolute bottleneck of the AI supercycle. On the other hand, you are buying into a historically volatile sector where aggressive, much cheaper competitors like SK Hynix are heavily armed and currently leading in next-gen tech. Which brings us to a critical inflection point in how the market thinks. If you believe this concept from our sources, that the AI cycle has fundamentally ended the old boom and bust memory chip cycles, transforming memory into a permanent, infrastructure-grade resource, then that $127 price tag is literally just the beginning of a massive re-rating. So I'll leave you with this to ponder. When facing an unprecedented technological shift like the AI chip explosion, which legendary framework are you going to trust to navigate the chaos? Do you stick to the cautious, margin of safety value principles, or do you chase the aggressive exponential growth? Thank you so much for joining us on this explainer, and we will catch you next time.